Like I would have loved to have.
Good morning, Professor.
Hi, good morning. Sorry, I had some admin here at home that ran over, so I'm here. We'll wait until 10:35 or so for everyone to join, and pick it up where we left off with the mortgages. If anybody has questions for me, you're welcome to ask them while we wait.
Good morning, Professor.
Morning.
Professor, I have a quick question.
Yeah, what's up?
So, is there any makeup? Like, do you give like extra credit work or anything?
I sometimes put out some extra credit. Let me see if it's out already. I can't remember if I set up extra credit for this course. Just 1 second, okay?
Mhm.
Yeah, I have extra credit set to, it's funny you ask, it's actually set to open tomorrow. And it will be due when the final exam and everything is due. So that will be 10 bonus points that would go, like, let's say, I'm just making examples, like let's say you get 80 on the final, then your grade becomes, if you finish the extra credit and get the 10 points, then your grade would become 90, like that. So I'll put the extra credit wherever you guys need it the most.
Yes, because I realized the other day that I actually missed one of your homeworks for the Blackboard. I mean, not for Blackboard. For YE Plus, I missed one of the homeworks.
Okay, so then, I mean, it's not going to be a one-to-one makeup because the extra credit is 10 points just on top of a grade, but it's definitely going to help.
Mhm.
That's for sure. All right.
Okay, thank you, Professor.
Okay. Yeah, thanks for asking that because I forgot that it's opening tomorrow, so I actually need to tell the class that it's opening tomorrow.
What is it about? Like which chapters?
It's covering let me see. I think there's stuff. I can look here quickly. I did this so long ago. I can't remember everything. I did it at the Pride in August, so it's ages ago. Yeah, so it's the same problem that we had in the exam, problem 13.1. To go over that again because stuff like that's coming up in the final. Then there's a bond transactions question, chapter 15, and then there's a statement of cash flows.
So it's only 3 questions, or is it
Yep.
10?
It's
Three?
3 questions, 10 points.
Ah,
And
okay.
it's unlimited attempts, so you guys can go crazy and do as many as, as many attempts as you need to. I definitely, definitely will answer questions also if people have questions about the extra credit. You can email me about it.
So the extra credit is gonna be on Blackboard.
No, it's in Wiley.
I mean,
It's in
I keep on saying Blackboard. I'm gonna say Y plus.
Yeah, it's gonna be in Wiley. So so you'll be able to see as you go along whether your answers are right or wrong. And you'll get feedback, but you won't lose points because it's unlimited.
Okay, and then moving forward for exam number 2 and the finals, will it be the same structure as the first exam that we just took?
Yeah, it's gonna be, you mean, is it multiple choice and then is it gonna be multiple choice and then exercises? Is that what you're asking?
Yes.
Yeah, it's gonna be that.
And then it's gonna be the same amount of same amount of questions, or will the final be more?
The final prep sheet is up already, so we can look at it. I can't remember exact question count, but it's there on Blackboard. I'll share my screen and I'll show you. Again, I have too many bits of information in my head to be able to accurately tell you guys, these things. But yeah, so where it says test and quiz information, if you scroll down, the prep sheet for the next test is there already at 6 questions. And you got to watch out because the last question is a full statement of cash flow. So you don't want to waste a lot of time. I noticed that, some people, I mean, it's mostly the people who didn't do that great on the first test, which is not necessarily just this class, because I have another class as well, that people spend too much time on the first question, the long question. Like some people spend 2.5 hours or over 2 hours on it. And what that does is it robs you of time to do the other questions. So please, just as an aside here, when you're doing these exams and tests and stuff, make sure that you spread your time evenly throughout the test, because I over provision time. It's people are not really supposed to run out of time for this. It means that you really didn't study that well if you're running out of time. So it's going to be 6 questions for the next test. The last question is a whole statement of cash flows. That's chapter 17. It's a long question. I just put it in order of the chapter. I first put all the chapter 15 stuff and then chapter 17. I don't want to move the cash flow up to be the first exercise, because then people are going to spend, half the time there again. I'm hoping that people will do the short questions first and gather some points. For the final, to your question about the final, it's 5 questions and it's already written here what's in the final. Okay, so there's no secrets in the class. You can see what I'm going to ask you for exercises on the final already, and it's 5 exercises also from different, one is from chapter 15, chapter 14, 18, 17, and then there's 13. So basically across the, we're going across the different chapters, but I'm telling you what in those chapters I'm testing. Answer your question?
Yes, it's sort of, will the final, but since the final is going to be covering almost everything we've done, will it be like more questions, or will it be just about like 20 something questions, just like the first exam?
Well, yeah, I'm telling you, it's 5 exercises and it's 10 multiple choice questions, so it's 15 total.
Okay, I got it.
You got it?
Yes, thank you. Will we still have 4 hours, or we have less time?
No, I'm giving you the same amount of time, 4 hours. Same amount of time. But again, like I said, I noticed people who ran out of time because you have to, first of all, and I'm not talking just to you, John, I'm just talking you, in the broader sense, the royal you, as we say. You have to study. It's 4 hours sounds long, but it becomes not as long when you might have, notes or something in front of you, but you still have to know how to calculate the numbers. And that's usually where people, don't think about it. They're like, oh, I can just refer to the textbook. No, not really, because you need to know how to put numbers into the, like, how do you calculate the stock dividend, for instance? If you don't know how to calculate that, then it doesn't matter if you have an answer from a previous homework in front of you, you're going to know the names of the accounts, but Wiley doesn't give you credit for that. It gives you credit for the account name and the number, the amount, I mean, next to the account name. So, so that's a word of warning that it's 4 hours, but obviously please study and then watch how you use your time, because if you have 4 hours and a test like this is probably written to take, if someone studied, it shouldn't take more than 3 hours. So I've basically baked in an extra hour because it's a new system that people aren't as used to, and I want to just not have so much panicking that people are running out of time. But like I said, what I'm finding is some people are spending like 2 to 2.5 hours on one question so that they can get it perfect. But that question in the previous test, test 1, was only 40 points. Right, so if the question's 40 points, but you're spending, 3/4 of the time on the or 2/3 of the time on that question, then you make it that you won't be able to get the points on the rest of the questions. That still there were 80 points available in 80 or 90. I can't remember if the multiple choices were two points or 1 point each, but anyway. That's only half of the points that are available. So for the next test, please just watch out. The last exercise is a statement of cash flows. It takes a long time. We'll go over it. We would have done chapter 17 by the time this rolls around. You don't have to panic about it, but I'm just saying, make sure that you know what's coming, because I'm writing it down here for you, that you don't waste a whole lot of time on exercise 1 through 5, and then you come to exercise 6 and it's like 30 points or something, and you've now run out of time. So the maximum you can get on the test is 70%. All right. So there will be, John just asked me, everybody who's joining, let me also just start recording. I hope I didn't say anything crazy while I was recording. So when it comes to extra credit, someone was asking about extra credit now. There's going to be extra credit opening tomorrow, November the 5th on Wiley. It's 3 questions. It's a like problem 13.1 from the homework, which was also in the test, just to give you another go around practice for that, because it's a very important part of the work, and it's also going to come up in the final. You can see in the final, there's a question with journal entries around common stock and preferred stock and so on. There's also a bond transaction question in this extra credit, and then there's a statement of cash flows. Statement of cash flows, you'll be able to do the whole thing next week, right? We'll probably start some of it today, and then from next week, Tuesday and so on, you'll be able to do it. This thing is only due, it's opening tomorrow, but it's only due with everything else, the final exam and so on, everything is due on December the 14th. So you have more than a month to do the extra credit. I would highly recommend that if you do have extra time on hand, just do it and get it done. Don't wait until finals week to do the extra credit, because that's when you're going to be going crazy with all your classes and you feel like you can't get anything done. I'm also, like I said, I'm available for asking questions. It's unlimited attempts. I expect people to get 10 out of 10 because I want you to grapple with the material and try and get this right. And you can certainly send me screenshots and things if you're stuck and you need help. I will answer questions about the extra credit because it's a learning tool. I don't want people to just kind of breeze through it, just copying and pasting or whatever. Okay, so that's happening. It's 10 points. So what do I mean by 10 points? As an example, if you get 80% on the final, if you did the extra credit, I add 10 points on, so your new grade on the final becomes 90. If you get 100% on the final, which is rare or close to impossible, but it does happen. But just for those people who, I will go above 100. So for instance, let's say you get 98% on the final, I will still add the 10 points if you need them, and your grade will go above 100. And I'm saying adding it to the final because usually I'll move the extra credit around to see where it helps you the most, but most of the time it has the biggest impact on people's grades if I add it onto the final exam grade. Another point that I don't think I've said this before in the class, so I just want to make sure that people know this, that it's my practice, because the final is cumulative. It covers, all the work that we did, that if your final exam grade is higher than the lowest test grade, then I will drop the lowest test grade. So let's say you got 70% on test 1, but you get 75 on the final, then I will drop the lowest test grade, and your grade will be 75 for the final and for the first test, and so on. All right. So there is hope. Sorry, go ahead, John.
I was gonna ask now, what happens if you do bad in the final?
If you do bad, I do not drop the final. Okay, there's no way that I'm going to drop the final. So you have to really pull out all the stops to make sure that you study and get this thing right. You have a 5-day window from the 9th of December to the 14th. If you know that all of your classes are testing maybe on the 9th and the 10th, then do our exam later on when you have some time to study or whatever. You only need to finish it by 6 p.m. on the 14th of December. If you bomb the final, even if you were doing great up to now, if you look at the let me see here. If you look at the grade weighting, the final counts 30% of your grade. I'm not going to drop it. Okay, so if you were cruising on like an 80% in the class and you decide that, oh, well, I'm on 80%, how bad can it really be if I bomb the final and I don't study? If you get 60%, right, on the final, because it counts 30%, right, of your grade will drop precipitously. Okay, it will drop a lot. If you just bomb it. So please, I know no one's planning to bomb anything. I'm just saying, don't be nonchalant thinking, oh, up to now I got 100% on the homework, I'm doing pretty good on the test, so I'm not going to try that hard for the final. This 30% is a massive weighting into your grades. So you don't want to take any chances, and make sure, I'm sure you have this for your other classes, but if you don't, ask your professor, make sure you have these weightings so that you know what's happening. I mean, some professors just do a 50% midterm and a 50% final. That's easy to follow. But for others, it might be difficult to know where you stand in the class because you don't know how things are weighted. For us, all our tests are 15%. The quizzes are 3% each. The homework, as you know, is 5% per homework, which gets you to 30%. This was the personal bio that you did at the beginning of the semester. There is a final review, a series of practice questions that I set up that will also be available that you can do for an extra 2% added to your grade. It's also unlimited attempts. You can take as many tries as you want. But then the biggest factor here is the final exam at 30%. So I can't substitute anything else for the final exam. So I would highly recommend that you guys think about, I don't know if you already know when your other classes are testing, but think about, what's happening here. We will review on the Tuesday, the 7th of December, which is almost just 4 weeks away. The Wednesday is the last day of class. Obviously, don't see you on a Wednesday. There's also homework due that Tuesday. And then from the Thursday up to the following, whatever it is, Monday, or I don't even know which day this is. I think it's the following Tuesday. You have to finish the final exam. And of course, I'll be contactable during that time. Does anybody have questions about the weightings, the calendar, the extra credit, anything that you need me to go over again?
Professor, what was this personal bio that you just mentioned?
Oh, it's here on the discussions board. That was due over here. That was due some time back already, and I've read them already.
Oh,
So
I made a personal bio. I didn't even know that.
if you did, you did. If you did, I mean, it was part. We can. I have the list of who did and who didn't. I'll have to look.
I just saw my name. I don't
Yeah.
even remember doing a personal bio.
Yeah, I mean, that's the nature of a busy life. You may not remember that
Yeah,
you
like
did
I had
it,
so many
but you
I
did
had so
it.
much assignments and everything. And I just saw that I did the personal bio. I'm like, wait, I saw my name when it.
Yeah, so it was due. I mean, you can imagine that even I can't remember everything because it was due and I read them ages ago. It was due on the 15th of September, which feels
Wow.
like 10 years ago, right?
Yeah, it's about to end right around the corner.
Yeah, yep.
All right, thank you,
Weeks.
Professor. I'm just glad I was able to do the personal bios and that I don't remember doing.
Yeah, well, it was part of, create your Wiley Plus account and do the personal buyout, send, notes to remind people. And of course, we met before that was due and we discussed it in class, right? So guys, thank you, John, for bringing this up. You can always ask me anything about how the class is graded, about what's going on with your grades. If there's something that looks weird, everybody should have their grades for chapter 14 now. After Lady reminded me the other day, I went in and just made sure that all the grades, all the grading was done. And what do we still have? Let me check here. So on the 9th, your chapter 15 homework is due at 6 o'clock. Again, please make sure that you are marking your calendar or doing whatever you can to get this stuff done. 5% is no joke, okay? Losing 5% of your grade immediately puts you, at a maximum of 95% that you can get in the class. So do what you can or do all of it, but make sure you're doing something. And remember, the homework is also practice for the test. So that's important. All right, so we'll move on today with finishing up chapter 15, which we're almost there, and then move into a little bit of chapter 17 to just set the scene for that. Let me just think if there's other, I don't think I know of any other really announcements from LaGuardia. I think you guys already know everything that I'm going to say. Register for your classes, make sure your vaccination stuff is uploaded. If you make sure that you can see all your classes on Blackboard, that you don't have any administrative withdrawals on your, in your information. If you need to go to campus, you have to be fully vaccinated and show proof of vaccination to get onto campus. So don't waste the trip if you haven't done that. There are people on campus at health services that can help you upload your vaccination information. So please do that. If you've registered for spring and you have a class that's in person or hybrid, February the 23rd is the last possible date that you can upload proof of vaccination. Otherwise, you'll be dropped from your classes in the spring. Okay, so again, we've said this many times. I want to make sure that you're hearing me, that you're understanding that this is, if you're only getting a booster, then you don't need to upload. If you already got 2 shots of the Moderna and the Pfizer, or 1 shot of the Johnson & Johnson, you're considered fully vaccinated for the sake of CUNY. All right, the boosters, you don't have to let them know about that. Again, if you don't know how to upload your stuff, or you are having problems, there are literally people on campus who can help with that. If you need to speak to me about that, feel free to do so. It's actually incumbent upon all of us to make sure that not only our stuff is done, but that we remind other people, because what will end up happening is you could be in you could be in a class of students, for, like, let's say all the math classes in the spring are going to be in person, right? So you could be in a class, that this class suits your timetable, it suits your work schedule, whatever. People don't upload their vaccination stuff. A whole lot of people get dropped out of the class, and because they get dropped, the class gets canceled. So you don't have that class anymore, and you may not be able to find another class that suits your schedule. So then boom, you're out of a class and you have to figure another way to make up those credits, either in the semester or even stay an extra semester. So I guess what I'm saying is, don't just worry about whether your stuff is done. Just make sure that you are even reminding your friends and your family or whoever else is at LaGuardia, to get with the program, because when people get dropped from classes, it doesn't just affect that person, it also affects all the other people in the class if the class gets too small and the administration says the class can't run anymore. All right, so it's all of our responsibility to make sure that the stuff gets done. Okay, so let's look at where we ended. I kind of know where that was, but I just want to refresh all of our memories. We were busy with the amortization table, and there at the end I started feeling like maybe we're going a bit too fast. So I said I'm going to slow down and go over this again when we come back together, because I know that specifically this question about how much of the liability is current and how much is long-term is problematic for for everybody, basically. Well, maybe not everybody, but it's a problem when we ask the question on the homework. People normally email me and say they can't figure it out. When we ask it on the test, that's normally where the points get lost. Okay, so let me go up back to the question here. The original question asked us about the 600,000 mortgage, a 10% annual, semi-annual installments of 48,145. It's a 5-year mortgage. You started on December the 31st, 2012, and they're asking for the first 2 installment payments. And then after that, they're asking how much is current and how much is long-term, but specifically at December 31, 2012, you have to know, you have to pay attention, to what the date is that they're asking about, because that will determine which payments you're looking at as being the current liability. So we went through, just again to refresh all of our memories, we went through and we said, okay, the easy part here is to do the journal entry, to record the mortgage itself. It's debit cash for the amount of the mortgage you're receiving. There's an assumption that you're receiving the money from the bank and going on to buy the property yourself, as opposed to the bank paying the seller. So you debit cash 600,000, credit the mortgage payable, right? And then we said, we know for the installments that the cash is always the same. You know this even from if you bought a place or your parents own a home, that they pay the same amount into their mortgage every month, unless it's a adjustable interest rate situation. But let's just assume that it's all fixed, because this example has a fixed interest rate. So you pay the cash 48,145, and then we said, but we didn't really know how to account for the split between the interest expense and the repayment of the mortgage. And then we said, in order to do that, we have to create what is called an amortization table, or in the book it's called something like mortgage payment table. In practice, like in real life, we call it an amortization table. I guess the book is just being, the book, which is fine. December 31, 2012 is when you took out the 600,000 loan or mortgage. Yeah, we know that it's 10% annual, but because the question said that it's a semi-annual payment, you're going to have to go with 5%, right? You got to halve it. Otherwise, you're calculating too much interest. Think about it. If you put 10% times 600,000, it's going to be 60,000, which is more than the whole installment that you're paying. So obviously, we have to go with half because it's semi-annual. So 30,000 is the interest based on the interest rate times the principal amount. From the 48,145, which is the actual cash that's paid, you subtract the interest, and that tells you that 18,145 is the reduction in the principal, which goes against the liability mortgage payable. So that's how you split the first payment. And this is when we were talking, on Tuesday, about how, especially within the first 5 years of a mortgage, it's actually pretty shocking how much of your money goes towards interest as opposed to the principal. And we also said that unless you have a prepayment penalty on your mortgage, which obviously you have to ask the bank about, you can actually put extra money to be applied directly onto the principal and not onto the, as a prepayment of the mortgage. So that's how we can save a little bit on interest by paying a little bit extra every month. I'm talking about for your own personal finance, not for this example. This example, they just pay semi-annual. Then the second payment, again, 48,145, this number stays constant. And so now you use the new principal balance multiplied by 5. And so you come out to interest. You come out to interest of whatever, 29,092.75. And again, the subtraction, so the repayment of the mortgage is this 19,052.25. And at that point, we went into B, and it said, how much of the mortgage is current and how much is long-term at December 31, 2012. Yes. C.
Hi. So I was not sure about the installments, because if on June 30th I paid 48,145, shouldn't it be taken off from the 581,855?
No, the 48,145 is the cash that you pay, but part of that cash has to go to the bank as payment for the use of the money in the form of interest, and only some piece goes against the 600,000 to reduce the balance. So the reduction in principal gets subtracted from the principal amount, not the whole 48. I'm not sure if this
I'm
is because
confused about the installment. I'm just not sure. What isn't it means that I paid it in cash?
yeah, but that doesn't mean that the whole amount goes is taken off of you pay in cash, and then because you are being charged interest, some part of that cash is going for interest, which you will never see again. It belongs to the bank because the bank is charging you for using their money, and only a smaller piece of that is actually going to pay off your mortgage.
So what is being paid for my mortgage? The
Just
30
reduction in principal. No, 18. I know it's crazy, right? It's the 18,145 that is the reduction in principal means that's what's being paid off against your mortgage.
Oh, so it means that so the time here that I paid 48,000, the interest is gonna be 30.
Yes, you're right. The interest is 30,000, and that goes to the bank. That's revenue for the bank. That doesn't go against your mortgage because that's just you
Okay.
paying to use the bank's money to own your home or whatever, right? The bank is charging you for that.
So basically from the 48,000, the only money they have taken off was 18.
Yeah.
Okay. now
And
it
that's how you and that's how you then that's why I kept saying for the first few years of your mortgage, like now I'm in January, we'll make 1 year in this house, and we're in year 1. I can guarantee you when I look at my amortization table, we're probably owing almost exactly the same as what we were owing when we bought the place, because it's the first year. I mean, you're paying almost nothing of the principal unless I decide to put some extra money on, which I probably will put a little bit at the end of the year. Okay.
In normal years, that's about the interest rate that they're taking, like 5%.
No, it's too high. It's too high. It's too high. It's for us now. I'm talking about now. In regular times, like maybe 10 years ago, whatever, yeah, the interest rate could have been 5%. 10% annual on a mortgage is high. Yeah, I don't know. It's a little bit high unless it's a really risky borrower. But I told you in the previous class that the Fed, right, the Treasury, they are keeping interest rates artificially low. In fact, yesterday, I think there was a news headline that said they're going to stop buying bonds now. They're doing all these open market operations to try and stimulate the economy, keeping interest rates low and so on. And so interest rates will probably start going up again soon. But yeah, this is high. But it's an example in a textbook. So, you got to always take it with a pinch of salt. Right now, an interest rate on a mortgage is probably closer to 3% annually. All right. But that doesn't make for a good question, because a 3% interest rate, 1.5 semi-annual, those numbers are low to prove the point, right, of the amortization table. All right. So then in B, we were asked, how much of if you look at the 600,000 at December the 31st, 2012, how much of the 600,000 is current? Like how much are you going to pay off of the principal in the next year? And how much of the 600,000 will be paid off after 1 year, right? So it said at December 31, 2012, how much is current? So I said the total that's owed is 600,000. We know that, if you say what is current, it means what will be paid between December 31, 2012 and December 31, 2013. So within 1 year. And the only thing you look at for being paid is the reduction in principal. You don't look at the installment. This is the question that C was just asking. She's saying, hey, but if I paid 48,000, how come it's not 48,000 coming off the principal? It doesn't work that way. Part of it is interest. So only the 18 and the 19 is what you actually pay off on your mortgage. So these two numbers together give you 37,197. And that's what, because you see there the date is December 31st, 2013. That is current, because these two are what we're going to pay from 2012 to 2013, 37,197. This is very important because people always mess this up, okay? So when someone asks you how much is current at December 31, 2012, you have to look ahead for 1 year to say, what am I paying in 1 year from that date? And this is the answer. And then what is long term? It's just whatever stays over, right? So you could, this is basically like 600,000 minus the 37,197, right? Or another way to just pick up the number is at the end of December 31, 2013, the principal amount that's left over is the long-term liability. It's 562,803. So you can actually pluck it off of the amortization table, right? So what do we remember when they ask you this question? You have to say, at what date are they asking me for this information? So I said to you, what amount will be current and long-term at December 31, 2013? Right, so now we're moving 1 year forward. And so you have to say again, this is what's current, right, is what will be paid between December 31, 2013 and December 31, 2014. Notice how you're always going a year ahead. And this was where I left it the last time, because I said in order to answer this question, we actually need to do another 2 lines on the amortization table so that we can see everything that will be paid in 2014. So at December 31, 2013, the total amount that we owe is 562,803. And we're going to split that number between current and long term. So where we left off was I had calculated for you, and remember, this is just going to be, oh, that's not what I'm going to do. This is just going to be the principal times the interest rate, right? That's what this number is, 28,140.14. And then this is how, do you see how the amount that's being paid on the principal is getting bigger and bigger because the interest is getting smaller and smaller, and the interest is getting smaller because your principal amount is getting smaller, right? So 542,798, I had highlighted that in red because that's where we ended the last time. So now I'm just going to do one more line of interest. I'm going to take the 542, which is the principal owing, and multiply it by 5%, and that's my interest amount. Let me just format this number so we can actually see what's going on here. Okay, so 27, and then subtract 48 minus the 27, so 21, right? And you know, if you keep these, Wiley will tell you how many decimals to keep, but I'm just showing you that this does add back up. And then over here, you're going to take the previous principal minus what was paid. So 521,793. So now you've, yes, Maya, go ahead.
Hi, Professor.
Hi.
I missed what you said for a second. You did 542 times what to get the interest?
5%.
Thank you.
Sure, it's off of the 10, right? Off of the annual rate because we're doing semi-annual payments. See, did you have another question, or is your hand still raised from before?
Still raised from before.
Okay,
So
no worries. Okay, Tanisa, I see you had something with your Wi-Fi. Okay, hopefully your Wi-Fi gets resolved. Right, so now I'm going to ask again, at December 31, 2013, how much of this balance that is owed, 562,803, how much of the balance is current and how much is long-term? And what do? We look at how much is paid between 12/31/2013 and 12/31/2014 to get the current amount. It's going to be these two together, right? So I'll add them up for you. So that's current, it's 20,004.86 plus 21,005.11. That's the current. And then what's long term, you can just pull the number from here, right? I don't know if there's decimals. Yeah. So you can actually just say, oops, where am I? No. Okay, you can actually just say equals, and you're pulling whatever is left to still be paid. At that point, that's going to be long term. And when you add these two numbers together, let me just do a sum over here, 562,803. All right. So the trick here with this mortgage business is you have to see what date they're asking you for current and long term. And you're always, to find the current amount, you're always looking 1 year ahead from the date that you're being asked about, looking 1 year ahead to see what is being paid within that year. Questions, anybody? Because after this, you guys are having an opportunity to do a question on your own. So ask now if you have if you have anything that you want me to repeat. All right, so let me show you this question. This is actually, I just look at the textbook. I don't know if it's also in your homework, but this is an extra example that I thought you guys would just practice to make sure that this actually sticks. It's exercise 15.10 in the textbook. So if you prefer to go via the textbook, you can find it there. Otherwise, you can, take I added this now, so it's not on the Zoom materials, but you can take a picture of this also if you want to, so you have it on your phone, but you're going to be working through it. And I'll go back to the previous question, to the example, so you can see how to do the work. But I'll read it with you, and then, take any questions that people have before you start working through it. So Trailing Company borrowed $300,000. So this is the mortgage amount, right? On January the 1st, 2020, that's the date at which you start, I guess that's the date at which they start owing the money, by issuing a 300,000, 8%, that's an annual rate, mortgage note payable. The terms call for annual, so not semi-annual like the one we just did, just annual, once a year, installment payments of 40,000 on December 31. All right, so you're just going to make one payment a year. So December 31, 2022 will be your first installment, $40,000, and you have to split that between interest and the principal reduction. Prepare the journal entries to record the mortgage loan. Remember, that's the first entry that's kind of, easy, debit, cash, credit, the mortgage payable. And the first two installment payments. For that piece, you need the amortization table. And then indicate the amount of the mortgage note payable to be reported as a current liability and as a long-term liability at December 31, 2022. So you're standing at December 31, 2022, and you need to look ahead to see how much of this thing is current and how much is long-term. So I'm going to give you time until 11:30, because it's going to take some time until 11:30 to do this whole thing. I'm going to give you now, whoever needs to take a picture of this question, give you 30 seconds to take your picture, and then I'll revert to the solutions page as soon as people are done taking pictures, if they need to take pictures. All right, so everyone should have this information somewhere in the phone or written down or whatever. Now I'm gonna shrink this a little bit so that you can see how I did the question. Hopefully you can still read that. Let me go a little bit. Okay, so follow this approach using the information, but remember it's annual installments for your question. So you're only doing one payment per year on December 31st. You have until 11:30 to do the question. You can ask me anything over the chat so that we don't disturb other people. Just type in the chat if you have questions. If it's something that I think is relevant to the whole class, I'll say it out loud. All right, so you have until 11:30 to do the question. Taking attendance, I'm just gonna call out 3 people who I don't see here. Lance, are you here? Lance, nurses. Andrew, nurse. And Scarlett, Jekyll. All right, everybody else, I've got your attendance, okay?
Professor, can you scroll that a little? I want to see the B part.
All right, I didn't hear that. What? Sorry?
I want to see the B part.
Yeah, this is the B part.
There's nothing more than that below it?
Yeah, but that's just for another year, an additional year. So, I mean, I'd have to make this font really small to show that as well. It's the same process though. Let me see if I can, hang on. I don't know if this is getting to like miniature size, right?
I'll just take a picture real quick.
Oh, okay, hang on then. Okay. That is what you wanted?
Yeah, I got it. Thank you.
Okay. Scarlett, I saw that you just came on now. I thought you weren't here, but you're here, right? Scarlett Pacheco.
I got disconnected and
Okay,
I just
cool.
got connected again. Yes.
I got you. Thank you.
Thanks.
Yeah, I got you, John. Don't worry. Okay, there's about 7 minutes to go. I see you, and do you have a question for me? Or do you want to answer the question?
No, I just finished. So
Okay, so I'll keep you until we take on, so no worries.
Mhm.
All right, so we're at time, so hopefully people got as far as possible with this, but I'll work it through. I'll have CL have you direct me. We'll work it through together. If you weren't able to completely finish, just stop me if you have questions about anything. So just give me a second to set myself up here and then we can start. So this was exercise 1510. Oops, where did this? See, from exercise 1510 from the textbook. And okay, do you want to start? See, what do you want me to do?
Yes, so should I start with the record, the mortgage loan, or should we do the graph?
I mean, we can do the yeah,
Just give you
let's
numbers?
no, let's do the recording of the mortgage loan, and then after that, and I'll leave some space, and then after that we can do the amortization table, okay? Because if
Yeah.
people get stuck, then they can know that recording the mortgage loan in and of itself is a separate thing from having to know how to do the amortization table. So tell me the journal entry for the mortgage loan.
So it will be on January 1st. Is it
Mhm.
true? Okay. We debit cash for 300,000 and
Yes.
we credit mortgage payable for 300,000.
Okay. For the same. Okay, so everybody should check that you have that as your journal entry for recording the actual mortgage, debit cash, credit mortgage payable, 300,000. This is not the correct information. I was just copying, I think it was 8%, right?
Yes.
8% annual. Okay. So then bring me to the
So first do the issue date, January 1st. It will be principal balance 300K.
okay.
And then December 31, 2022, we'll do a cash payment of 40K.
So the question, so just bear with me, I'll just go back in case someone got lost. The question gave us the installment of $40,000. It also said that it's annual payments each year on December 31st. Thank you. Continue.
And then, so the interest expense will be 24K.
So we're gonna say 300,000 times 8%, and it's 8%, not 4%, because this is annual, not semi-annual. So that's 24,000, yes. And then how do we get the reduction in principal?
We do 40,000 minus 24,000, which is
16.
16,000.
Okay.
And
then-
then the principal balance will be 300,000 minus 16,000, which is 284,000.
Okay, and then you can go up if you choose to do it now. You could, do it all together, but at this point, you know what to do. This is the first installment, right? Because the book asked for the first two installments, so this is the first installment. So walk me through the journal entry for that.
We'll do interest expense. We'll debit interest expense 24,000.
Yes, you just pick it up off the table.
We'll debit mortgage payable 16,000. And then we'll credit cash for 40,000.
Yes. And the credit to cash is always the same amount every installment. Thank you. So what's next?
So the next one will be December 31, 2023. It will be the same cash payment, 40,000. And then interest expense will be 22,720. Reduction of principals will be 17,280.
So just to repeat here, the interest is calculated as 284,000 multiplied by the 8%. So we come up to 22,720. Then we subtract that number from the 40,000 to get the reduction in principal. Thank you. And now?
And then the principal's balance will be 284,000 minus 17,280, which is 266,720.
Thank you. So now we're in a position to journalize the second installment, which is at December 31, 2023. And you're again, I should have put it back. Sorry, 1 second. All right, you're again going for interest expense, right?
Yes.
And that's gonna be
22,720,
mortgage payable.
17,280,
Mhm.
and then cash 48,000.
All right. That's the second installment. So let's just take stock again, prepare the journal entries to record the first two, the mortgage loan, excuse me, and the first two installments. So we're good, right? We did the first two installments. Now we need to indicate the amount of the mortgage note payable to be reported as a current liability and as a long-term at December 31, 2022. So let's go over here. There wasn't really an A and a B, but I'll just do like 1 and 2 or something so that we can just differentiate between. So December 31, 2022, right? That's how much is the amount that is owed at that date? See?
16,000.
No, the total, what is the total that's
Total
owed?
amount, 284,000.
Right, the total that is owed is 285, I mean, sorry, 284,000. That's what you're working back towards. Now the question is what is current and what is long-term? Current is what is going to be, sorry, I don't know what I'm doing here. Okay, current is what is going to be paid between December 31, 2022 and December 31, 2023. So what do you want to tell me about that?
So it's gonna be paid between 22 to 20. So
Mhm.
it's gonna be the 17, right?
Yes, yes, I
So-
was hoping my prompt would help you because the 16
Now
is
I get it.
the 16 is already paid, right?
Yeah,
At
yeah.
December 31, 20, the 16,000 is already paid. That can't be current. That's already been paid. Current is always looking 1 year ahead. So in this case, you only have that one payment for the next year. So it's going to be the 17,280.
Yeah, I
mhm.
calculated before from the 300,000 by accident.
Yeah, I mean, this is the problem, with this thing, you gotta be so careful because you gotta ask what date are they asking for? December 31, not January 1, right? The other one did sorry, let me go back up and explain properly what I'm saying. The other one asked for December 31, 2012, but this was December 31. In this question, the way the setup is changed because they borrowed at the beginning of the year, not at the end of the year. All right. So you got to watch out. And then how much is long term then? See,
268,000.
do you mean this?
Sorry, no, my bad. 284,000 minus 17,280 equals 266,720.
Which is the same as the ending principal amount at the end of that year. It's always going to be like that. Okay, because what you're saying is after you pay the current amount, this is what's left over to be paid in more than 1 year.
Can you show the example of the last question also? Like, why is it from the first installment?
Yeah, let me just wrap this up and then I'll go back to the other question. So I just want to emphasize for the people who maybe are still struggling here on why this is the answer. And I'll go back to the previous question in a minute. You have to check which date the question is asking you to start from, right? In this case, the question said you're standing at December 31, 22. What is current? What is long-term? What is going to be current is anything that is paid between the date that you're at, December 31, 22, and 1 year from that date. So December 31, 23. Because this question only has annual installments, it's not two amounts like how we added up previously, the two amounts in the previous question. In this case, you've just got one amount that's going to be the amount that you're looking for. It's the 17,280 because that's what's going to be paid in the next year. year. The 16,000 has already been paid. It can't be due again. It's already paid. So the 17,280 is current. And then you can get to what's long-term either by saying how much is owed at this date, which is the 284 minus the 17 gives us 266, or you just pick the number up off the amortization table. You're telling yourself at December 31, and I'll type it here, at December 31, or at December 31, 2022, this amount is what will be paid in more than 1 year. All right. Everything is about December 31, 2022. Questions on this example before I go back and revisit the previous one? Anybody have questions or points of clarification here? Okay, so this is definitely a homework question. It's definitely a test question. In the sense that you have to be able to calculate the amortization table, or at least the calculations that go into it, even if you don't create the table itself. Now, see, you asked me to go back because you wanted to see something. Yeah, tell me what it was.
No, I just wanted to see how we got the current and the long term last time.
So you start with going back to this question here, and you'll see, right? The question said at December 31, 2012, what is current and what is long term. And so December 31, 2012 is over here. It's basically day one of the loan. So you're trying to split the 600,000. Excuse me, you're trying to split the 600,000 between current and long term. So you're saying what is paid between December 31, 2012 and December 31, 2013, that is current. Because this was a semi-annual payment situation, you actually have two amounts, right, that are going to be paid between 2012 December 31 and 2013 December 31. So that's how we got to the 37.
Oh, no, it
197.
makes sense. Okay, so whenever they give me a date, I just go to the date in the payment
1
date.
year, 1 year
And
from
then,
that date.
It's gonna be the principal amounts on the same payment date that they gave us. Okay.
Yeah, it takes practice. You guys should try to do it again on your own. Like I said, there's a high frequency with these questions. With this question specifically, the split between current and long term. There's a high frequency with people emailing me when they're doing the homework, struggling to find the right answer. And more often than not, the problem is that you have to look at the date that they are asking you, right, on this date. What is current and what is long term? When you start with that date, current will always be within 1 year, whatever's being paid within 1 year, and long term is after 1 year. Okay, so that's the story with exercise 1510. We'll break now. When we come back from break, we just have to go a little bit over leases. It's a very simple and easy part of this chapter, and then the chapter's done, and then we'll spend some time on chapter 17. I just want to say this before I forget, that today's office hours is only going to be for 30 minutes. I'm going from 1 p.m. to 1:30 if anybody needs to see me, because I have to do parent teacher conferences for my daughter's school at 1:40. Okay, so 1:30 is when office hours will end today if you do need to see me. Okay, so we're on break 11:43, so come back let's say 11:54. Okay, 11:54, and we'll do leases. All right.
Professor.
Yes.
Can you look at an example from the chapter, from chapter 15, and clarify something with me? It's from
Yeah.
the textbook,
Mhm.
from
Which one?
mortgage notes payable. So it will be kind of like the same examples we did. Not sure which page it is.
Yeah, I mean, it's hard to know pages on this
My
thing.
summaries.
This.
Yes.
Mhm.
So they don't write the dates there. You see the issue date. So
Mhm.
the issue date will be December 31, 2022, right?
Mhm.
Okay, and then the first installment will be 2023.
Yeah, I mean, it says that they're doing annual, let me see, in each installment, they're doing annual installments. Yeah, so you have to assume, because it doesn't tell you that it is December, but it has to be because that's 1 year from the issue date. So December 31, 2023, 24, 25, 26. Yeah.
And
I mean,
then,
I know why they did it like this in the book, because they save themselves on editing time to change the dates on the table every time a new edition of the book comes out.
oh, okay.
Yeah,
This
it's not because this is the way that it would be shown in real life. It's just easier not to have to update the table every time the question changes.
Okay, and then if they're asking us what's the current liability and the long-term liability at December 31, 2022, theoretically.
Mhm.
So it's gonna be, the current liability will be 10,926 and the long-term liability will be the rest, right?
489,074.
Mhm.
The long-term liability is just gonna be this amount over here.
And if they're asking for the date of December 31, 2023, it will be 11,800.
800, and the long-term will be 477,274.
Okay, perfect, clear.
Okay.
Thank you so much.
Just excuse me for a second, guys. All right, so the break is over and we're back. I think we kind of wrapped up everything that we needed to wrap up here in this work on the amortization table. There are examples in the textbook as well. And of course, like I said, there will be homework on it and you'll be able to practice there again. So just to wrap up on the actual chapter, go ahead, Michelle. Yes.
Sorry, Professor. I just wanted to let you know that I have to go to the doctor, but I'm gonna try to call in. It doesn't have like on the Zoom link how to call in, but I'm gonna try to log in on my phone. So if a random number comes on, it'll be
Okay,
me.
okay, that's fine. Yeah, I don't know that yeah, I never put it on Blackboard. That's actually my oversight. Do you need me to try and send you how to
No,
call
it's
in?
okay.
Okay.
I think it sometimes allows you
Yeah, if you
to like
click on the
do it
link,
on the phone. Yeah,
if you have the app on your phone, it will send you through.
yeah,
All
yeah.
right.
So
Okay.
okay.
Okay. No problem. So leases, I think many of us are familiar with leases because we live in New York, so we're familiar with renting apartments and storage units and what have you. In accounting, there are two types of leases that we deal with here. One is well, I mean, first of all, just obviously the bottom line is that a lease is a contractual arrangement. If you've ever had a lease for an apartment, I hope that you would have signed something, right? A contract to say that what your rights are as a lessee, or if you were even the lessor. You don't want to, even if you're subleasing from someone or whatever, you need to make sure that you are not just like showing up and putting your stuff down and finding out afterwards that it was an illegal sublet and you have 24 hours to leave or whatever the case may be. I mean, that's just life stuff, right? Just reminding everybody that, look, make sure you have a contract. And if you do get a contract, make sure you read it so you know what's allowed and not allowed in the apartments that you are occupying. Depending on the management company, sometimes, they want to move the signing of the lease fairly quickly. I mean, I've leased many apartments in New York, so I've had this experience where they kind of don't give you that much time to read the lease contract sometimes if you're in the office or even online, but take your time and make sure you know what you're agreeing to. You are allowed to question things. I mean, when my husband and I, the last apartment we leased before the second last apartment we leased, we had certain things removed out of the agreement because it seemed like they were just old stuff that was in there that like made no sense whatsoever. And it's better to have that stuff removed. And I mean, the management company was fine with removing it, but once you sign something, you are contractually bound to it. So read the contracts. Now that I've said that, a lease is a contractual arrangement. There's the lessor, who's the owner of the property that's being leased, and the lessee or the renter is the one who is actually using the property. Two types of leases exist within our work that we're doing here. There's something called an operating lease. It's not a long-term lease. It's less than or equal to 1 year. Although if we talk about New York type stuff, you're obviously not the owner of the apartment that you're leasing, and sometimes you have a 2-year contract. That's still an operating lease, okay? It's intended for the temporary use of the property by the lessee while the lessor continues to own the property. So this is why, if you're leasing an apartment and there's suddenly a leak in the tap or the fridge stops working or whatever, you have to contact the landlord because they are the owner of the property. So the risks and rewards of the property reside with them, and it's their responsibility to fix whatever is broken. Sometimes they'll tell you to fix it and they'll just reimburse you. That's fine. But the point is the actual expense is theirs. As it relates to the lease itself, the journal entry for the lessor, the one who's picking up the rent revenue, is debit cash and credit rent revenue. Okay, this is revenue is obviously it increases on the credit side. This is kind of a no-brainer, right? Their cash is going up and they're also recognizing rent revenue on the credit side. Then for the payment, for those of us who are leasing, the payment by the lessee, debit rent expense, it's an expense to you, right? And credit cash. And I don't know why I put to record rent revenue. I think I must have done a copy and paste. Sorry, it's supposed to say to record rent expense. I forgot to edit after I copied it over. So this year, just make sure that if you are following on the notes that you make this change as well. All right, so that's an operating lease, right? It's just a rent revenue for the landlord and a rent expense for the lessee. And then for capital leases, this is the second type of lease. This is a lease that term greater than 1 year. This is used by, there's a number of industries that use it, but one of the popular ones is airlines. They don't actually own, they don't buy their aircraft and own them. They often lease them. And what ended up happening, some years back is that the Financial Accounting Standards Board, which writes generally accepted accounting principles, they and this is even for international accounting, many years back, like in my day when I was studying, kind of felt that companies were leasing property for a long time and treating it as operating leases. But when you looked at it really closely, you realize that because the companies were leasing these properties for, or not properties, assets, sorry, it could be any asset, leasing these assets for most of their useful life, it was almost as if they owned the asset. But because they were treating it as operating leases, they never had the asset on their books, and they also didn't have the liability on their books. So, they could have like a 10, 15-year lease of an aircraft, but you don't see any liability to show that in future they actually owe all this money. All you used to see was just a rent expense going out and cash going out. So GAAP changed that, the FASB changed that and said, if you have, a lease that is going for more than 1 year, and there's been basically, the risks and rewards of ownership are transferring to you, it's almost as if you bought the property. So you have to have the property on your financial statements. It's often called a right of use asset or leased asset, depending on, the company can call it either one. I think in the book they go with right of use asset, saying that, right, we have the right to use this asset, even though we don't technically own it. And then the credit side is the lease liability, and this is going to be at the present value of all the payments to be made in the future. So companies weren't finding this so great, because now suddenly they have massive liabilities on their balance sheets that they didn't have before. But from a user of the financial statements perspective, from the people who are actually looking at the financial statements, it helps them to get this information to see, oh, there's this massive liability, that's coming on, and does the company have enough money to pay for this lease in the future, right? So that's the capital lease. It's a right of use asset debit and a lease liability credit. So even though you don't own the asset outright, the risks and rewards of ownership reside with you because you're leasing the asset for such a long time. So the rules say that you have to treat it as if you own it. Questions on the theory before we do a very teeny tiny example, and that will be the end of it. The lease part of the chapter is really small. So anybody have questions about this leasing, operating lease or capital lease? All right, so let's look at the question. Yeah, exercise 8, prepare the journal entries that the lessee, right, the person who is actually leasing the stuff, the lessee should make to record the following transactions. Sorry. In an operating lease transaction, the lessee makes a lease payment of 100,000 to the lessor. So if you go back here, we said for an operating lease, which is this first one, this is the journal entry, right? Debit, rent, expense, credit, cash. So, I'll just go in here and do this, put in the solution, because it's, it's fairly obvious at this point what the answer is. All right, so you're gonna put rent expense because you are the lessee, 100,000, and then cash 100,000. That's it for the operating lease. That's for number one. And then for number two, again, hopefully super obvious, but with one little wrinkle. I'll read it and then I'll talk to you about the wrinkle. Olive Company leases a new building from Crown Company. The present value of the lease payments is 550,000. The fair market value of the lease, of the building is 600,000. The lease transfers ownership to the lessee at the end of the lease. So there is an ownership transfer. More so than even just the risks and rewards of ownership. There's an actual ownership transfer. So this is definitely a capital lease. All right, so we're going to debit right of use asset and credit lease liability. But now the problem is we've got two numbers here. There's the present value of the lease payments at 550,000, and then there's the fair market value of the building at 600,000. So we have to choose which one we think we're going to have to put into the transaction. So because we are recognizing a liability on the credit side showing that we owe all this money, we will go with the present value of the lease payments. Present value means what is the amount today, right? In today's dollars that I'm going to be owing over time. So that is the definition of a liability, right? That's the amount that we're actually going to be paying over time. Whereas the fair market value of the building is just what the building could be sold for today. That isn't necessarily what we owe on the lease. Okay, so I'll repeat. We go with the present value of the payments as the amount that we will record the transaction at, because the present value of the payment shows the actual liability that we have, because it's saying as of today, how much will I owe, right, for this lease? 550,000. So that's the amount of the liability. The fair market value of the building is just what you could sell the building for. That doesn't mean that that's what you actually owe the lessor. So we go with 550,000. And the debit is right of use asset, weird name, but just telling someone who's reading the financial statements that we have the right to use this asset. It's considered to be our asset, even though we don't own it outright, okay? And then, so you're not going to put like equipment or building or whatever, because we don't actually own it. And then the credit is to lease liability. And again, we use the 550,000 because the present value of the lease payments is our actual liability. Questions, anybody? Okay, so that's really the beginning and end of leases. This topic has been made much more much simpler over the years. It used to be way more complicated with all kinds of rules and regulations around capital leases, but it's been simplified where the gap is just saying, you know, if you're leasing something for more than 1 year and there's some type of transfer, the risk of ownership, you got to record it as an asset and you got to credit the liability. If you are just in an operating lease where you are leasing it for up to a year, you just have use, you don't really have ownership of the place, it's an operating lease, you just record an expense and the lessor will record revenue. So you know, I do realize I don't want to jump the gun here. There is one thing that I just want to show you in the financials. We don't have to recreate it over here, but and I think there might be a question in the homework about this, so I just want to show you. As we've been going along, you know, when we were doing the bonds, I showed you this, and with these other liabilities, it's not so easy to create a question about this because it's just fairly obvious where it goes on the balance sheet. But I just wanted to show you in this illustration 15.15, it shows a long-term liability section of the balance sheet, like how we organize our balance sheet. So remember, even from, you know, the first few questions that we had, first of all, you know, it's the name of the company, the balance sheet is just a partial balance sheet, and then the The major heading would be liabilities and shareholders' equity. Then this is long-term liabilities. Liabilities are split between long-term and current in a classified balance sheet. So long-term liabilities, bonds payable, that's the face value of the bonds. Remember, if there's a discount, you subtract the discount. So less discount of 80,000. So this is the carrying value of the bond at 920,000. If there had been a premium, you would have added it and the carrying value of the bond would be higher than the face value. And then here's a mortgage payable. This would be the long-term piece of the mortgage. So remember all these examples we did with what part of the mortgage is long-term. So let's say we were looking at this example, we would take the 266,720 and put it into the balance sheets, right? As the long-term part of the mortgage. So the mortgage gets split between what's due within 1 year that goes to current and the rest goes to long term. That's why it's so important to know how to do the split. And then the last piece is this lease liability. We just did a journal entry related to this. If it was this example, the liability would be 550,000, you know, in what they give you over here to show you how to set this up. It's really just the lease liability. It's all just listing the stuff. The most difficult part of any of this is knowing to add or subtract, right? The premium or the discount. Everything else is just a listing of the amounts. And then total long-term liabilities here in this example, 1,860,000. So that's the balance sheet presentation. Again, not something, it's not like, you know, chapter 13, where you had all the stuff to do with stocks and it got a little bit, you know, crazy and you had treasury stock to deduct and all this, you know, these, a lot of concepts. This is mainly a listing of long-term liabilities. So refer to this when you have, or if you have a question in, and I think you do. Let me actually just see if I can go back here. I don't know if I've been kicked out already of Wiley. Oh no, I'm still logged in. That's great. So for chapter 15's homework, let me go in here and see what's what. Because I think there's a question on this. Yeah, so you have some bond transactions. This is the amortization stuff. Yeah, and so reporting and analyzing long-term liabilities. This is not the one. That's just the difference between stocks and bonds. Let me see if it's this one. Yeah. So you have an example in your homework, which is basically the same thing, except that there's a premium, okay? And then there's a lease liability and you total it up. So they give you the stuff listed like this. You have to remember that interest payable is going to be current. It's not long-term. You're not going to wait. No one's going to wait more than 1 year for you to pay them their interest. Interest is just a current liability. Interest payable, excuse me. Lease liability, bonds payable due in 2027, and the premium on the bonds payable, those are all going to be the long-term liabilities. You start with the bonds payable at face value, you add a premium, right, to get to a carrying value that's more than the face value, and then you just list the lease liability, and that gets you to total long-term liabilities. That's it, okay, as it relates to the presentation of the balance sheet. Does anybody have questions for me about balance sheet presentation or any other stuff on chapter 15 before we move on?
There are talking in textbook about something use of ratios. Do we need
Yeah,
to know?
we'll do the ratios in chapter 18. We will destroy the ratios in chapter 18. So I'll just save it for then. I'll check. I don't think I put anything in anywhere in the homework that's going to require you to do ratios. If I did, then I'll come back to it. I'll double check, okay?
Thank you.
Yeah, anything else, guys, that you want to know? Let me make sure that this thing didn't ask. Oh, it does ask for earnings per share, but earnings per share is from chapter 14. Because it's trying to show you the difference between issuing bonds and issuing stocks. So this ratio over here is not from chapter 15, it's from chapter 14. Other than that, I don't think there are any other ratios in this homework. And then I just have to audit the quiz and stuff to make sure I didn't use ratios in there. Okay, so
The homework is open now, right, Professor?
Oh, it's been open since, yeah, it's been open since September. It's due on Tuesday. Mhm,
Okay.
mhm,
Okay, but thank you.
mhm. Okay, so, and again, you know, it's how many questions, 10 questions, some of these questions are super quick, right? It's like one journal entry. So try to knock out, you know, 2 or 3 questions a day between now and Tuesday, and then you'll be done. You don't have to say, oh, I need, you know, 3 or 4 hours to sit and do this. You can do them, you know, as you go, because you have unlimited attempts and you have unlimited time, so you can go in and out and take as much time as you need, but maybe just split up the work so you don't end up sitting, you know, on Monday or Tuesday trying to do 10 questions. It becomes very overwhelming at that point. All right, so now I have to ask myself, did I put your chapter 17 stuff in? Oh, okay, so I wasn't too crazy. I thought I wasn't sure if I put the chapter 17 notes in Blackboard, but I did. So I'll give you, for those who do follow the notes, I'm gonna give you maybe 4 or 5 minutes to just get into Blackboard and download the notes for chapter 17, and then we'll, you know, just do some talking around a statement of cash flows. And really go deep. We'll go much deeper into it next time, but I will kind of set the scene for you for what we're doing with statement of cash flows, because next time, well, not on Tuesday, but next week, Thursday, I have to take some time away from the cash flows to go over the homework for chapter 15. So today I'll take back my 30 minutes or whatever. All right, so go into Blackboard if you need to, and get the notes. One more minute to get into Blackboard if you still need to. All right. So we start. Let me go here also on the textbook. So you notice we skip over chapter 16. There's no work for us to do in chapter 16. You'll do investments with me if you are an accounting major. Well, maybe not with me, but you'll cover investments in intermediate accounting too. All right. So that's not something you need to worry about in case you know, suddenly think you forgot to study a chapter or something. Chapter 16 is not covered in 112, and many of you are not accounting majors, so you know you will never need to worry about investments again. So this is the, you know, preview of the chapter talking about cash and so on. I will give my little spiel as well here about this chapter. So the statement of cash flows is one of the financial statements, right? That's where we need to start with our understanding of what's going on here. It is part of the financial statements. Up to now, we have dealt with the income statement, sometimes called the statement of operations. We've dealt with the balance sheet, which, you know, we're very familiar with because we've been doing it, you know, all the time in chapter 13, 14, and now even in chapter 15. But remember, in 14, you had a dedicated time to the income statement as well. Now we come to the statement of cash flows, another financial statement, and this is probably the first time that you're going to hear as much information about it as you as ever. I don't know if in accounting one, your professor may have mentioned that it exists, but there was no requirement to cover it in accounting one. So if you think about the information that's provided in the income statement and the balance sheets, right? The income statement shows you revenue and expenses, gains and losses. The balance sheet shows you assets, liabilities, and stockholders' equity. And of course, on the balance sheet, you do have a cash balance as part of your assets, right? But there is still something missing when we think about what those two financial statements provide us. And what's missing is what we would call the sources. So where did cash come from? The sources of cash and the uses of cash. What did we actually use the cash for? Nowhere on those two financials does it really give us a picture of how cash moved in and out of the business. And the other, and this is a slightly more sophisticated topic, but we'll talk about it a lot in this chapter, is the income statement and the balance sheet are based on accrual accounting, which means that we record the transactions as they happen, whether or not we actually received or paid cash. All right. So accrual accounting isn't driven by whether cash was received or paid. So that could mean, if you think about a company, that could mean that a company could have a whole lot of revenue. So they made a whole lot of business, but they actually don't have any cash because they're still waiting to collect the cash from their customers, right? So you could, let's say you have an accounting practice where you're doing people's books, for instance, that you're doing some of their data entry or recording journals, and you're doing all the work as the month goes by, but let's say by the end of the month, no one paid you yet. You will be able to record revenue because revenue is what you are recognizing for all the services that you provided that happened. But you would also have to record accounts receivable because you have not received any cash. So that could become, problematic if you just keep going, doing the work, and you never actually collect cash, because eventually you won't be able to pay your bills, right? And this is where the saying sometimes that people have in business, that cash is king, that's where it comes from, because you might look super profitable, right? You've got all this revenue and you're containing your expenses and you're doing everything right. But if you're not actually collecting cash from anybody, then you're going to go out of business for sure. Let's say you have an events company and you're doing all this work to set up, a wedding or something. You're running around making the place look good and so on. You should really have somebody else, even if it's a family member, who's dealing with the accounting side of things to make sure that the people pay you what they need to pay you before the event happens. Because after it happens, and everybody got whatever they were supposed to get, they probably won't be that interested in hearing from you that you still owe them. I mean, that they still owe you money. But then if you didn't collect the money, you won't be able to pay your workers, you won't be able to pay yourself, you won't be able to pay your bills. So, over time, companies, or I guess not over time, but in general, companies need the information that the statement of cash flows provides, because it tells them for the different parts of their business, and it's divided up into three parts: operating, which means their day-to-day business; investing, which means things that they may have bought and sold, like property or equipment or whatever, and other stuff which I'll get into; and then financing, like loans that they took out or stocks that they issued, bonds that they issued. It tells them for all the different parts of the business how much cash did they generate from that and how much cash did they pay. And one of the easiest ways you can tell that a company is probably going to go bankrupt is if the cash that's generated from their operating activities, meaning their day-to-day activities, gets lower or starts going negative, because that means that just by being in business, they are using up more cash than what they are generating. And you can think of this principle in your own life, right? If you're working at a company, you work for 2 weeks and you get paid at the end of the 2 weeks. when you get paid at the end of the 2 weeks, you have to pay your own bills. But let's say the company says we don't have money to pay you, then you've got all these bills and you've done all the work, but you don't have the cash to pay for it, right? So it's whether it's an individual or a company or whatever, cash is something that is needed in order to function. And unfortunately, the income statement and the balance sheet don't tell us enough about the ways in which cash flows through the business, and maybe even the places where we need to do better with how we handle our cash. So this, the cash flow statement provides all this information. The book will tell you about the company's ability to generate cash, to pay debts, to pay dividends, the reason for a difference between net income, which is revenue minus expenses, and the actual cash that is generated by the company's operating activities. And again, a lot of this could be because we have accounts receivable that we haven't collected and other stuff. And then also, how much cash did they invest? What kind of financing did they get through the year, and so on. All right. So our business in this chapter is going to be to learn how to create a statement of cash flows from beginning to end, right? And like I said, the statement of cash flows is separated into 3 areas. And within each of those areas, there's going to be cash coming in, which is called cash receipts, and cash going out, right? Which is cash payments. So we start with operating activities. Right, out of the 3 sections, this is how the cash flow is structured. Operating activities, again, implies that this is your day-to-day activities that the company is engaged in, whatever their business is. So if you're the events company, we're talking about all the work that you do around your events. If you're doing, the books of companies, all the work around that, not other things that you happen to do on the side. So includes the cash effects of transactions that creates revenue and expenses, so items which impact net income or net loss. So you're looking at those types of items. And for the cash flow, there's steps to follow to calculate these amounts. I'll show you all the steps, but I just want you to remember for now that there are 3 sections to the cash flow. One of them is operating activities, and it's got to do with the day-to-day activities of the business. The second section of the cash flow, investing activities, includes buying and selling assets, so property, plant, and equipment, also lending money or collecting money, buying stocks or bonds for investment, but let's just say buying stocks, things of that nature. Okay, it's if the company is engaged in some of those investing activities. Now, notice that this is not part of their day-to-day, right, operating activities. This is extra stuff that they're doing. So maybe they own a piece of land and they sell it in that year. That's just happening once. It's not happening every single day. So investing activities is the second part. And then the third section of the cash flow is financing. And financing, I mean, if you think about it in your own life, if you finance something, you're getting money, right, to pay for something. So a company could finance its business through debt or equity. We've already spoken about equity, issuing stocks, right? You could also buy back stocks like treasury stocks. And then there's also debt, like issuing bonds, mortgages, and so on. Those are all the ways in which financing activities could happen. Remember, for each of these sections, there's cash receipts, money coming in or money going out through payments. And so for financing activities, they include cash flows from issuing and repaying debt. So again, debt could be mortgage payable, bond payable, whatever. And B, cash flows from issuing shares. So that's your common stock, your preferred stock, repurchasing shares, that's your treasury stock, and paying dividends. All right. So when the company pays dividends, it goes with all the stocks and stuff, it goes into financing activities. When the company receives dividends, weirdly, and this is just because, I don't know, the FASB sometimes is weird. When they receive dividends, it goes into operating activities. Don't ask me why, but we'll go through a list in the textbook well, it was a whole long, accountants, as exciting as accountants can be, right? They had this whole big argument about where dividend receipts should go and settled on operating activities. I don't know, if that's the best answer, but that's the answer that they came up with. the operating activities is way important. It's probably the most important part of the cash flow. It's also the hardest part to do, of course, right? Murphy's Law. But it's so important because it shows the cash that's provided by the company's operations, its day-to-day business. So if you have a business and you decide to build a cash flow and you see that your operating activity cash is negative all the time, then you have to change something, all right? Because that's telling you that you are burning through cash. You know, being in that business. Maybe you're charging things to credit cards and doing all kinds of stuff to stay afloat, but you have to try and find sources of cash. This is also in your personal life, right? I mean, for all of us, if we find that we're sitting with debt, you know, our operating activities are day-to-day. Simple things. Look at the price of food. Anybody who's in charge of, like me, in charge of their budgets at home, and you start seeing how the price of food has skyrocketed in various ways. Now you have to think, right? My budget was X for the month, and it's now going up by 25% or something. If I don't have more money coming in, I'm going to be in a negative situation, right? For cash flow from operating activities, because just for our day-to-day eating, drinking, whatever, we are spending over what is coming in, for instance. So we will have to make some changes. My husband and I just had this conversation, I think on Sunday night, where I said to him, you know, the prices of all these things have gone up. It's resulting in, you know, incremental increases in our food spending. And we also have a lot of, I mean, you guys don't care about this, but just maybe you also have this. We have a lot of dietary restrictions in the house because of allergies and stuff. So we have to buy specific things and, you know, blah, blah, blah. So I said, you know, the prices are going up. We keep buying the same things, but the prices are not staying the same. So we came to the conclusion that we have to go to Costco, which, you know, I was doing a lot of food delivery, go to Costco and try and buy some of our staples again, you know, from cheaper places, so that we can try and save some money, because our cash flows from operating activities was negative, right? And what happens if that's negative? It means that you are borrowing from somewhere to fund your, you know, your day-to-day. So you're taking money from next month's budget, or you're putting stuff onto a credit card and not paying it off or whatever. So, I mean, I'm saying this to just try and make it real for you guys. I know sometimes it's when we do companies, it feels like it's in the abstract, but this applies across the board. It applies to all of us, okay? So let me go into the textbook, because it does provide a very nice list of cash flows in and out under the various activities. I just want to find that page. Yeah, you see, you know, some nice little pictures about operating activities, right? Day-to-day activities, investing, you're buying property, you're buying equipment, a truck, whatever, and financing is either stocks or bonds. That's what I was just saying. So here's the sheet. I can't give you page numbers. I don't think there are page numbers being given, but you can find it in, it's like in the first section, the usefulness, I think it's in the usefulness section of the book. So types of cash inflows and outflows, operating activities, right? This is what comes in and out. So cash inflows, you know, we'll start the operating activities with net income and then adjust net income to get it to a cash amount. But the things that go into it are, you know, the cash that comes from selling your goods or services, any interest that you receive. And remember, I said dividends received, not dividends paid. Dividends received also goes into operating activities, weirdly, even though dividends paid goes into financing activities. So watch out for that. That could be like a really, you know, typical multiple choice or something. Dividends, you know, asking, does dividends received go into financing or not? Cash outflows that fall into operating activities, what you're paying for inventory in cash, salaries, taxes, interest expense, other expenses. Okay, so these are the types of things that make up your operating activities, and that's why I was saying it's kind of dangerous if you calculate operating activities and find out that the number is negative, because that means that what's coming in from your sale of goods and services is not enough to cover everything that's going out, to pay for your wages, to pay for inventory, to pay for all the other things that it takes to run a business, right? So that's operating activities. Any questions up to here? I've been speaking for ages. So anybody want to add something? Ask something? Sorry. All right. So, if people either really following or already asleep for half an hour. Right? So investing activities, that's the next section. Changes in investments and long-term assets. There could be cash coming in from selling any property, plant, and equipment, right? So you sell a building, you sell a truck, you sell a piece of machinery, sale of investments in debt or equity securities of other entities. So maybe I have a company that bought stocks, as an investment in another company, not to own that company, but just to have the shares to trade on the stock exchange. That would be an investing activity. If I sell that stock, it's a cash inflow. I could also invest in somebody else's bonds payable. That's part of the investments work that that I was saying we don't really have to cover in this class. Also, if you loan money to other companies, the collection of that money is going to go into investing activities. As soon as you put money into someone else, whether it's a company or a person, you're investing in them, right? So there's also a lesson to say, do you want to invest in that person? Someone comes to you and says, hey, give me $100. I need to do it for, I need $100. So it's the first question you ask, what for? Right? If they say, oh, I need $100 because I got to go out to the club this weekend, I mean, they're going to spend the $100, and then what return do you have on your investment? Nothing, right? Maybe a hangover. And then how are they going to pay you back? So when you loan money to people, you're what's someone telling me here in this thing? Okay. When you loan money to people, whether it's a sibling, a friend, a family member, my rule of thumb, and I'm veering of course, but these are important things to remember in life. My rule in life is I only lend money to family and friends, money that I can afford never to see again. Because I value my relationships with my family and friends, and I know that money comes between people. So if someone asks me for money and I can afford to give it to them, I give it to them expecting that I may never see it again, and then behave in a way that, even if they don't pay me back, we can still have a relationship. So when I'm giving them the money, I'm investing in them. Of course, I'm going to ask them what it's for. Of course, I'm going to figure out by when they'll pay me back, but it's entirely possible that they may never pay me back. And so do I want the relationship to end because of money? Personally, no. So if I feel like whatever they're asking me for sounds kind of sketchy or dodgy, then I'm just going to say, no, I don't have it, right? Because I value our relationship more than having to run around behind you to get my money back. That's just, that's just me. So we're investing in people or in entities, and so we're collecting, the principal on those loans. And so cash outflows to buy the property, plant, and equipment, to invest in debt or equity securities of other entities. So, if I have my accounting practice, but I also decide that as part of my accounting practice, I also want to create an investment portfolio, and I decide to invest in a few stocks, of a company that's going public. I think Sweet Green, the salad company, I think they're going to have an IPO soon. So I decided to invest in that. Then that will be an outflow under investing activities. And then also to make loans to other entities, that's an outflow. That's what I was just talking about now, right? When you give money to some entity, like your brother-in-law, sister-in-law, that is an outflow. I love the tacos. Yeah, Sweet Green makes really good food. I'm curious to see at what price they're going to try to list on the stock exchange. It's probably going to be higher than I can afford. But I'm curious to see what they're going to do. And yes, the taco salad is on point. So that's investing activities, and the last one is financing activities. So changes in long-term liabilities and stockholders' equity. Cash inflows in financing activities comes from the sale of common and preferred stock, right? Because when you issue the stock, there's cash coming in and the stocks are going out. Also from the issuance of debt, because when you borrow for bonds and notes payable, there's cash coming to you and you also have to recognize the liability. And then the outflows are when you pay dividends to the stockholders. We're not talking about stock dividends, we're talking about cash dividends, actual cash. And also when you pay back your debt, and also when you buy treasury stock. So this is a nice, reference guide here to tell you, what types of payments. Do you need to memorize the whole list? Obviously not, but you do need to be able to build a statement of cash flow. So you'll see the same things repeat over and over. So you do need to have some familiarity with where things go on the cash flow. There are also things called non-cash activities, almost said non-operating, non-cash activities. This is things like, if you remember when we did issuing stock for non-cash assets or services, so you issue stock for land, there's no cash involved, so it can't go into the statement of cash flows. You issue debt and you buy to buy something, so you don't actually get the cash, you just buy a property or whatever, that's going to be non-cash. So sometimes there are things that go into the statement of cash flows. Well, they don't go into the statement, they go at the bottom of the statement of cash flows that aren't actually cash. And so this illustration just shows the beginning of what a statement of cash flows can look like. You can see it has the main headings: cash flows from operating activities, investing and financing activities. We will work together through all of these, and eventually when we've done all the inflows and outflows in each section, that will come up to a grand total that's either going to say your cash increased or decreased during the year. And then to that, you add whatever cash you had to start with, and you will calculate the cash at the end of the year. So what this means is you can actually check your work, because in a lot of these questions, I'm seeing if I can show you a balance sheet. In a lot of these questions, they'll give you a balance sheet. So what we're trying to do is say, in 2021, cash was 33,000, right? In 2022, cash is 55,000. That's a 22,000 increase. And we are trying to explain that 22,000 increase in the 3 different sections of the cash flow. Because remember, an overall increase can be many increases and many decreases to get to this amount. And then our cash flow statement will end on 55,000. So we will always know what the answer needs to be. And I think over here, they go step by step by step, but if you scroll down far enough, you'll get to a point where they actually work through. I know this is overwhelming, so don't worry, I'll show you next time. But I just wanted to show you here, this statement of cash flows at the end is 55,000. All right, and that's the same as the ending balance for cash on the balance sheet. So lots to look forward to. Lots to look forward to. Next week, Tuesday, we're going to hit this thing hard. Next week, Tuesday is not a class to miss. I know you can listen to a recording as well, but it does help to actually be in the thing, in the class at the time, so you can also ask questions. But it's going to be a pretty heavy going class to do statement of cash flow. So please come with your coffees and your papers and have things downloaded and be ready for action. I'll leave you with this, maybe not the best thought, but statement of cash flows is probably one of the hardest topics in accounting. It just is. But I will take you step by step so that by the end of this, everybody in the class will be able to do a statement of cash flows. I can promise you that. But what I need from you is your full concentration during the class. Try and get rid of, all the different distractions, your full concentration, and also to maybe spend, even if it's just 10 minutes to read a little bit ahead. You don't even, if you can't get to the textbook to read ahead, even just read on the notes that I gave you guys, just so that you can see what's coming, so that it's not going to be completely, I'm terrified. Don't be terrified. Remember, you should be terrified if you didn't have me guiding you through this. I will guide you, and by the end of this, everybody will be like, yeah, I know how to do that. Okay. But I can't, I'm not at your house, guys, to say, oh, stop looking at Instagram while I'm talking, or whatever it is that you're doing. You got to be ready for action on Tuesday. Okay, so that's where we'll leave it. Homework is due on Tuesday at 6 o'clock. Come to class on Tuesday for statement of cash flows. Be ready. Please read a little bit ahead so that it's not such a shock to the system. And you're dismissed. Go and have a good day. Last reminder that if you plan to come to office hours today, I'm only doing 30 minutes because I have to go to another meeting. Okay, have a good day.